Welcome back. Well, let's get straight to the next management on the show, which is ICICI Lombard. It reported a mixed set of numbers. To discuss what went on in the past quarter, what's to be ahead, we have the company's CFO and Chief Risk Officer, Mr. Gopal Balachandran, who joins us on the show. Hi, Gopal. Thanks a lot for joining in. Well, though the premium growth has been strong, your underwriting loss only increased by around 8%. So what's the strategy to improve the underwriting performance, and what could be the kind of improvement we expect on a sequential basis for the remainder of this fiscal?
Just to kind of refresh, I would only say that the more the businesses grow, given the fact that the earnings, as you rightly mentioned, happens over the contract period of insurance, whereas the costs are front-loaded. So to that extent, when you look at it from an absolute underwriting outcome, in times of growth, obviously you'll obviously see that number slightly showing an elevated outcome. And that's exactly how it has played out even for us. But I think the larger thing that I would keep saying is a better number to look at is more the combined ratio outcome. And there, if you would have seen, let's say for Q1 of last year, we were at roughly at about 103.8 in that range. And the current quarter has been about 102.3%. And if you look at, and that's where we get a lot of a positive from, given the fact that there has been an improvement in both growth in revenues. I think even equally the loss ratios have been largely maintained, and the fact that the expense of management has been within the regulatory stipulations that has been laid out. So I think, which is where if you look at the combined ratio trajectory, I think that's looking very well for us, in line with what we have been talking to the market as well. And for the exit of Q4 of FY25, we have spoken about a combined ratio exit of about 101.5. So if you look at in that context, I think directionally for us, the combined ratio trajectory is moving in that direction. As I said, aided by renewed growth momentum, obviously a lot of focus on the loss experience, and more importantly, efficiency and productivity in the way we are running our operations. But from an absolute underwriting outcome, given the fact that the expenses are taken upfront, whereas the earnings of premium happen over a period of the contract of insurance.
So the combined ratio has improved to 102.3 versus 103.8. Which segments saw the biggest improvement this time in terms of combined ratio, and what's the FY25 target on the combined ratio? Also, what will that journey look like quarter on quarter now?
So again, if you were to put that in the context of the market, I think if you look at the market is, as I said, still elevated at an aggregate level as 102, 112. Within that, I think if you look at motor as a category, which by far is, of course, the second largest to the industry revenues, that has obviously seen some improvement from 121% to, let's say, 118, but it is still elevated. Now, obviously, the trajectory that motor combined ratio takes and the industry combined ratio takes is something that we will very, very closely watch for. But at this point of time, I will take the second question first of yours in terms of how do we see the exit of combined ratios for ICICI Lombard towards end of FY25. At this point of time, we are sticking to the thought process that we have spoken to the market, which is, as I said, trying to get to a combined of 101.5% by exit of Q4 FY25. This obviously is in the context of how the market environment plays out, and that's something that we will very, very closely watch out for. Your first point on where have we seen the improvements in the combined ratios, I think, as I said, it's been all round. I think in general for us, we have been able to see an improvement in our combined ratios on commercial lines. Even for us, motor, I think the combined ratios improved relative to the last year. And even on the health side, I think on the corporate health specifically, given the fact that we are able to win accounts at our price, again, I think the combined ratios have been positive. On retail health, I think at this point of time, given that we are making those investments in expansive distribution, obviously the combined ratios for the time that we continue to make these investments, the combined ratios will stay elevated. But what we are happy about is the fact that it is running at a loss experience that we are comfortable with.
Got it. Gopal, now loss ratios in health segment spiked to 83.6% as compared to 78.7%. Was it because of individual or the group segment, and what would be the target to reduce the loss ratios in the health business too, both retail and group? If you could detail that out first.
I think again, as we kind of put out even as a part of the earnings call, on the health side, again, if you look at for Q1 specifically of this period, I think what we have seen is possibly some elevated increase in frequency of claims. and obviously to some extent also an increase in the average claims cost as well. But that's something that we will watch for. Quarter two in general for health is slightly elevated consequent to the monsoon season. So therefore we do see some increased incidences of claim. But having said that, I think for the rest of the year, insofar as both the segments that you kind of talked about, whether it is corporate health or whether it is retail health, I think the loss ratios range that we're comfortable on the corporate side is generally in the range of about 94 to 95%. And on the retail side, I think we're comfortable operating at a loss ratio of about close to 70%. So the good news is, I think the kind of the portfolio book that we are building up possibly gives us a confidence that we should be able to end the year at those levels of loss ratio ranges.
All right, Gopal, for health, the growth in the premium for retail segment moderated, whereas the employer-employee was strong. What's the management's intention to grow retail or the employer-employee? And what share do you see retail and group by the end of this fiscal?
So if you ask us, health as a category is a preferred segment for us. Now that obviously kind of includes both, as you rightly mentioned, employer-employee as well as, let's say, the retail health. Now, when it comes to employer-employee, effectively as what I was talking about, in the past, there have been challenges from a market perspective. The market, because the loss ratios for that segment was significantly elevated. Now, obviously, thanks to some of the improvements in pricing that the market has seen, which is why I talked about the fact that for ICICI Lombard, we have been able to win accounts at a price at which we are comfortable with. And hence, that gives us the confidence that we should be able to run that book broadly at a loss ratio range anywhere between 94 and 95%. But if you ask us, is that an area of thrust? Of course, it's an area of thrust, given the fact that there is an improved pricing sentiment that is playing out in the market. So hence, to that extent for ICICI Lombard, that's a very, very preferred segment. On the retail side, again, as I mentioned, that's an area where currently we are in an expansive mode. And thankfully, the way we have been kind of expanding the book, as I said, again, is leading to a loss outcome broadly at a loss ratio range that we're comfortable with, which is at about 70%.
Are you looking to take any price hikes in your health portfolio?
If you ask us, I think at this point of time, we believe we are fairly priced in terms of the health insurance offerings that we have, particularly on the retail side, given the fact that that's a solution that we have kind of recently put into practice. But having said that, obviously, that's something that we will keep looking for in terms of the loss outcome of the portfolio that we're underwriting. At this point of time, as I indicated, I think the loss ratio range that we are largely comfortable with is operating on the retail side at about 70%. And to that extent, we believe, I think we are kind of fairly priced. But obviously, we will see the experiences play out over the subsequent quarters. And should there be a need for us to do any kind of a price revision, obviously, we will come back and talk to the market specifically about that. But more importantly, I think if you ask us, a larger focus for us is also on trying to manage the cost of claims. And to that extent, I think there's a lot of focus that the company has been kind of doing in order to make sure that we are also able to keep the cost of claims under check.
Got it. Now, loss ratio in the motor segment has also come down. It's down to about 66.8%. And in the property and casualty segment, is down to about 74.9%. Is there further scope, as you see it, to reduce loss ratios in these segments, and to what point?
On motor, as a category, I think generally we are comfortable running at a loss ratio range between 65 to 67%. And within that, we have talked about on motor own damage, a loss ratio range of between 60 to 65. And on third party, a loss ratio range between 65 to 70%. So that's in motor as a category. On the property and casualty, which is largely, let's say, the commercial lines, I think, again, we would keep saying that I think it's very difficult to look at it from a quarter-to-quarter basis, primarily because some of these catastrophic events can have an impact in the loss numbers for that particular given quarter. So let's say, for example, in a given quarter, you see 2-3 flood events or catastrophic events. But naturally, given the nature of the business, obviously, we will see some losses. But when you look at it over a longer period of time, which will kind of play out in terms of averages, I think at this point of time, commercial lines for us has been one of the best ROE generating segments of businesses as well. And that's a segment where for ICICI Lombard, we have been continuing to increase market share as well. And hence, therefore, to summarize, both on motor and the commercial lines, the loss ratios range over periods are kind of well within the range that ICICI Lombard is comfortable operating at.
Gopal, we'll leave it there. Thank you very much for joining us and running us through all of that detail and a fair bit of guidance as well as you see it. Thank you for your time.